Hey there, Disney. So it's a while that I haven't been talking about strategy and how to leverage the price movements, how to exploit the price movements of strategy to actually capture some opportunities. Whether you're bullish or bearish, personally I'm bullish, about the future, there are opportunities out there to capitalize on your conviction. So first of all, I would like to look at the graphs and where we're coming from and where we are at, because I think we are forgetting now where strategy is coming from and the huge advantage that it has versus other fresher and newer, even if faster moving Bitcoin treasuries. First of all, now we almost reached all-time high that we reached back in November. There is some price volatility, and the price has been moving a bit like after we climbed up back in March 2024, but we have much more Bitcoin. I would say the morale, the vibes are really low at the moment. So I would guess that most people who wanted to exit the trade and stop being long, they're not long anymore. Potentially they are short, or maybe they're just investing in other companies that they feel more tuned with. But once again, I think we are going higher. Above all, there is Standard & Poor's inclusion, Strike and Strive that keep getting more volumes and allow us to buy more Bitcoin. So I would say don't fade Michael Saylor, and let's see where this goes. But let's say, I want to use actually, let's say, these moments to learn something, to share something about options. I selected 3 different tabs to look at certain graphs on gammaleaf.com. And I invite you to visit it. It's very cool. I built this tool just because I needed a tool where to check historical data for options. And we have the several tickers, several BTC treasury companies. We have MSTR, CEP, GameStop, Tesla, who yesterday purchased, right? Tesla. We have also IBIT and MSTY. You can look at calls or puts, and we will look at both in this little short video. So here I'm in the Performance Explorer, and I selected for simplicity just options that are calls that are expiring in December 2025. I like to look at, instead of option details, which gives the detail by contract, where I can interact then with the chart axis, I like to look at the option comparison, because I can compare different contracts and see how they evolve over time. First of all, I wanted to take this period from back in March 2024 because there was some contracts were already live. For example, the 140 contract was live, and I want to show what's the value of option through this chart, what you can achieve if the price moves up or down. Here we were in April, actually, April 2024, we were, the share price was at $66. And so if you would purchase a 140 strike call expiring, it's a leap, so expiring in 2025, December 2025, you would have spent only $15. So tiny, like a small amount compared to buying the share. This strike was at the time very much out of the money. Would be probably an equivalent of around 800, buying an 800 today, or even more, actually 1080 today. But then as we know, the price moved and the price increased, and with the price increasing, of course, a very deep out of the money option moves more than just the price itself. Here we have the premium percentage change over time if we enter the trade on the first day where the contract was available, and we would see that already when the price increased, well, a lot, by 165%, or here by 200%, our strike, our $140 strike would have increased to by 700%. You can see also that other contracts were available later, and when, of course, there was a big euphoria, another climb, each contract actually increased a lot. I just want to point out these because options, if you have a conviction in the direction of price, you can definitely get exposure at a cheaper amount rather than buying the shares yourself, and get exposure to the price increase by magnifying the returns. For example, these 140, if you would have waited long enough, already here you would have, as we said, got 700%. You could have decided to keep it. Of course, you can see it's very volatile, then your 700% returns would have dropped, the value would have dropped down to 184. So also pay attention, because as it increases fast, also decreases fast. If you would have bought here the max at the top, you would have the value of your contract would have shrunk quite fast. But long enough later, when the price climbed up again, we can see that the peak which lasted very, very short time. So you would have been very good in catching it, almost impossible in my opinion. But potentially you could have reached 2,400% returns. Now, so this is the potential. But of course there is risk, because as you know, the expiration, if you need to decide if to convert, if you can, if it's in the money, or probably rolling out or sell, and so on. So it's very, the premium of the options of the contract is very sensitive to price movements, and also to the demand of the option related to the option contracts. That's why I find exploring historical data very valuable, because you can monitor actually demand of contracts and see how things are evolving. But to make an example which is a bit more recent, here for example, I selected the 400, 600 and 180 strikes expiring in December 2025. Why these strikes? Because I've got all of them. Actually, I got a 400, 700, 1080, and I got them for different reasons. So, and I want to use these instead, these charts, to explain a very basic dynamic that there is between deep in the money calls. So, for example, deep out of the money calls, for example, the 1080, and less deep out of the money, for example, the 400, which is definitely within reach. We are very close to that at the moment, even if the price has been trending down for the past few days. So here I imagined that we entered the trade on at the bottom in April, and just to show how the different premiums, so if you would have bought these contracts, how your returns would have, how the value of your contracts would have evolved, and returns would have evolved. So as we see, they are very highly correlated, so definitely they move all along, but the percentage returns are slightly different, whether you are more out of the money or less out of the money. Indeed, we can see very clearly from these, from the premium percentage change, from this graph that I really love, we can see that far out of the money calls are more sensitive to price changes. So what does it mean? Above all, to sustain price changes. So when the price starts to trend up, they are a bit more explosive, so they react more than less out of the money options. So for example, here the peak, they would have been the best performance with 293% returns versus 254 for the 600 strike and 227 for the 400 strike. But then careful, because of course when the price starts dropping, they are also more sensitive to that, and as you can see, they revert here, and they start dropping faster. And at the moment we are here, we don't know, like at the moment they are holding still. Well, if you entered around here, probably you have similar performance, but if the price would continue to trend down, then they would start performing worse and worse. Now, what drives the premium of the premiums of these contracts? Well, both the price. Of course, if the price moves up, then any contract that gets closer to being the money, then increases the value. But also, it's very important to take into account the implied volatility, which is basically a proxy of demand. relative demand and supply relationship of the option contracts. And here we can see, for example, that implied volatility has been moving down for all the contracts. So the demand relative to the supply has been trending down, and this trend is there for a very long time. We know that there was a euphoria in November when there was a rally up, and there was a lot. The implied volatility went very, very high, around 200% for some contracts, and then it has been trending down. The point is, when volatility trends down, like it is definitely able to impact the premium of the options. Even if the price would be stable, but implied volatility, so the demand relative to supply, would trend down, the value of those contracts would still drop. And this is true also the other way around. That's why if you're very bullish about MSTR, then a period of low volatility, the price in a local bottom that you believe to be the local bottom, then it's a perfect setup for for opening any call contracts. Because then you will have the possibility to achieve those, as we saw when the price increases, to achieve those higher returns, whether a few hundreds to even sometimes, if you are good in timing it, 1000%. Now, I said that this call, like this video was gonna be also about who's bearish. So if you're bullish, this is for you. Like, calls can help you definitely magnify the return. Keep in mind that, as I said, less in the money, out of the money contracts trade more similarly to the stock, while more out of the money contract trade with much more sensitivity. But if you are bearish, then I want to show you this. So let's say you are bearish and you wanted to enter the trade when there was huge euphoria, then you would have to pay a bit, in my opinion, a bit of attention, because still the price of MSTR, despite it was trending down, then overall the price is overall the opinion of the crowd, the market, is actually very bullish about MSTR. And at least we can see this from the options data through the implied volatility. And we can see that despite there was trend down of the price, the implied volatility for these puts, of course, it started to trend down faster than the price, and these cause the premium. We can see it from the premium percentage changes, but also from the premium itself, kept trending down, even if the price would have was trending down. Despite this contract, of course, if you have a put, you are betting on the price of the stock to go down. So when actually the price goes down, it's good for you. And I would have expected to see actually the premiums to go up, but instead they kept trending down because there was the implied volatility going down, so the demand for this contract to go down, except when the price moved very, very fast. For example, we see it here, the price moved down very fast and the premium jumped up. So of course, so my let's say my advice, or actually this is not financial advice at all, but by my point here, what I want to point out is that you need to be very careful also with puts, because if you would have entered here, then you would have had quite of an expansion. So your puts would have performed very well. So for example, the far out of the money, the 150 would have passed from $12 to around $23, which is quite a good returns, around 80% returns. But if you would have played the long game, then the implied volatility would have actually crushed you significantly. So if you're really bearish, I hope you're not, I'm not. There are, in my opinion, this is quite a risky way to play the bearish game. I rather would invite, I mean, as everybody's doing actually, and I'm not big fan of that personally, but to consider selling covered calls. In that case, the risk is limited. If you can collect premium over time, exposing yourself to a maximum sell the shares you already have. Well, this is it. Personally, just maybe last word. Personally, I opened some in the past when we were down in April. I opened some 1080s. They are not particularly in red yet, but I believe we will go higher. I have long expirations. I bought some September as well. That if the catalysts don't show up, I will have to roll out. But I also bought recently, as the price trended down in the last few days, a 400 contract. And why a 400 and not a 1080? Well, I know that the far out of the money calls are more sensitive to the price increase. So if this would be a local bottom, it would be definitely better to hold, to have a 1080 with long-term expiration. But since I feel already, for example, this is just a psychological trick that I use, you can use, but since I already feel exposed, I feel more comfortable to have contract that trades a bit more like the stock, but with higher returns. So the returns will be still very high the moment we go in the money, and the more in the money we go, but it will be less explosive than a far out of money option. So it's very important as well to, when thinking about options, to really think about what's the type of risk that we personally are feeling we want to take on and expose ourselves. Remember that there is always an expiration, so don't let the time pass, and there is data decay, so the premium of your option drops over time. And so if you have catalysts that justify letting a lot of time pass because if you expect bumps in prices or increase in prices, well then that justifies indeed like even getting close to expiration in some cases. Well, I hope you enjoyed this, and feel free to comment, share. Please consider this is not financial advice whatsoever. It's just what I see through gammaleaf.com, this tool that I've built to explore historical option data, and I hope it's of good use to any of you, and I wish you a very great day.